Hi everyone, welcome back, and I hope that you all are at home and safe. Lately, I've received a number of comments and queries about gathering funds for development and specifically using OPM or other people's money for real estate investments and to build your own portfolio. So, today we're going to talk about what exactly this OPM is, whether it can work in Indian real estate, how developers in India use OPM, and finally, some of the risks related to debt financing in real estate. So, what is OPM? OPM is a concept that has become really popular because of Robert Kiyosaki, the author of Rich Dad Poor Dad. Basically, it is a strategy to start earning from real estate without investing any money of your own. However, as another famous real estate investor, Grant Cardone, has put it, there is no such thing as no money down. No bank will give you 100% of a property's value as a loan, and this is one thing that doesn't really change regardless of which market and country you are in. So basically, this OPM or other people's money is a way of taking a private loan from an investor to cover the down payment portion of a property investment. In this OPM model, you have to have an exit strategy, whether that is through the rental income you earn or by selling the property at a higher rate. This is how the OPM model of real estate financing is supposed to work. And now let's have a look at how this applies to the Indian real estate market. One of the biggest problems for this OPM model in India would be the mismatch between the interest rates for the loan to purchase the property and the rental income from the property. As we have spoken about many times on this channel, the rental yields for residential properties in India are quite low, ranging from about 3 to 5% at most. However, given that the rate of interest for both home loans and construction loans in India, which tend to be above 7%, is higher than the rental yield you can expect to get, there simply isn't enough spread for you to make money yourself and to pay off the private loan you have taken for the down payment portion of the purchase. One of the biggest components of this OPM model, as Robert Kiyosaki puts it, is to give your investors a good deal. Further, risk and return tend to go hand in hand. If you are new to this industry and are approaching a private investor to raise funds for your first property purchase, for example, they may want a higher rate of interest to be compensated for the higher risk that they are taking. The next issue is that in Indian real estate, your track record and your level of financial experience matters a lot more. As we have spoken about on this channel in the past, the real estate industry in India has been plagued with many problems such as unfinished projects and high inventory overhangs. To be able to use OPM and make money off it, you need to know how the real estate industry here works in the first place. To even approach an investor to raise funds for construction, for example, you have to show some ability to be able to complete the project. As Robert Kiyosaki himself puts it, using OPM to build a portfolio requires a high level of financial intelligence. So now let's look at how developers in India have been using OPM or other people's money through the years. The rate of interest, especially for construction loans, is heavily dependent on the track record of the developer involved and their ability and history of completing and delivering projects. The construction loan rates for even large builders are above 9%. In the past, developers in India would typically use short term unsecured loans from private investors to raise money. This process is also known as borrowing from the market, and developers would use this to put down payments for new projects, after which they would sell prospective flats to investors early and then use these collected funds on top of bank loans to complete projects. However, by using this system over the long run, a lot of developers face problems with leverage and debt, mainly due to incomplete or delayed projects. However, this situation has changed a bit since RERA has come in, which brought in more stringent regulations in the way that developers can raise funds from the market or private investors. Further, RERA also tied funds to specific projects to prevent developers from raising funds, becoming over leveraged, and leaving incomplete projects in their wake. In India, another tool used by developers to expand their reach through debt financing is lease rent discounting. We have spoken about this concept before, and it involves taking a loan against the regular rental payments you receive from a commercial property. If you have a rented out commercial property, most banks can give you more than half the total value of the rental contract as a loan. Further, banks tend to prefer lease rent discounting over construction finance in times of uncertainty. When construction loan rates were really high at 12 to 11% in June and July last year, LRD rates remained much lower at about 8.5 to 9%. In uncertain times like right now, when we're seeing lockdowns, rent discounting has its own risks as well. For someone who has made use of rent discounting to take a loan against a rental contract, it may become a problem if the tenant is unable to use the space they had rented out or unable to pay the rent itself. For example, most malls use rent discounting once the properties inside them have been leased out. However, since the pandemic, this has caused a problem for some mall operators. Alright, everyone. I hope that this video explained what OPM or other people's money is, why it may not work too well in an Indian market, and how developers in India raise funds for construction and make use of OPM themselves. As always, if you enjoyed the content, please do remember to drop a like and to subscribe to the channel, and I shall see you all again very soon. Thank you.